Welcome back to this live coverage. We'll continue in the studio here today. With me is Ms. Cristina-Gabriela Mirica, Business Development Consultant and former Country Director of Oxford Business Group. Ms. Cristina, thank you for being here with us today.
Thank you so much for having me. It was a pleasure to be here last time, so I'm happy if I can continue the discussion today.
You're very welcome. Now, let's get into it. From an economic perspective, how serious is the current regional unrest for the Gulf economies overall, and what immediate economic indicators are analysts watching for?
So definitely this has a lot of implications for the global economy. We see that there have been a lot of risks, right, associated with the current situation. For the economies here, there's two aspects we can mainly look at. On the one hand, there's positive aspects, which is increased revenue from increased oil prices, and that's mainly for countries that are high exporters of energy, such as Kuwait, Saudi Arabia, even UAE. And this aspect is unfortunately offset by the instability that the recent tensions produced. And here we talk about issues in trade flows, increased costs of shipping, of global supply chains, we could say, and investor sentiment, right? Investor confidence that's been shaking. Your second question was more about?
What indicators are analysts looking for during these times?
Exactly, yes. I just wanted to be sure. So, financial analysts are currently looking, I would say, at the situation from four main aspects. One of them is obviously the oil prices. Oil prices matter because it indicates the amount of revenue that local governments are going to receive. Then we're also looking at volumes, export volumes. How much of this revenue is going to reach based on how much export is going to go through, how much of this oil is going to reach global markets. Then we're looking obviously at costs, exactly what we were mentioning, increased costs in insurance, in shipping and logistics. And a fourth factor would be investor sentiment. And for that, we would be looking at stock exchange markets, at capital flows. We know that in such situations of crisis, usually short-term investment decision-making is delayed.
Now, we've touched base on oil. We'll get into more details. I have a few questions about that I want to ask you, but beforehand, like you mentioned, there is a crisis in our hand that will affect the economy in the region. Some view it as a high risk and some view it as a potential for growth. Now, what measures can government take to shield domestic markets from global economic shocks?
So this is a great question. When we look at what's currently happening, in the actual context, we can look at a few factors. First of all is to ensure a steady supply. And this has been already partially done. The main measures that we've seen governments take was increase the number of suppliers, and we have seen a shift from affected markets, which in this case would be GCC, where the higher risk is, to alternative markets, such as United States, Australia, Norway, parts of Africa, and if I'm not mistaken, it was recently Japan that is highly dependent on energy imports that has announced such measures. Then we would be looking also at tapping into the energy reserves, things that have been already announced, and probably trying to supply more of the energy reserves, even if it's at a higher cost from global markets. Then we would be looking as a second step at protecting the end consumer. And protecting the end consumer means taking a few measures. It would mean some cutting the fuel taxes, maybe adjusting, offering some subsidies, some targeted subsidies in this period. It could be measures that make sure that the end consumer doesn't feel the volatility of prices that much. And a third would be, obviously, from a financial perspective, ensuring financial viability of these markets. And here we would be looking, because in such situations, what we see is volatility. We see investors, not taking such short-term decisions that they usually take, and we see also that banks might be more reluctant in lending to businesses. So this is where central banks can take measures, mainly by injecting liquidity into the banking system to still ensure support for local businesses. We could be talking also about lowering interest rates, and then obviously it would be tapping into foreign currency reserves to stabilize the local currency.
Do you think this unrest can accelerate economic diversification across the Gulf?
Of course, and this is a subject that we have been tapping partially last time. We have seen through all of the previous disruptions or crises that there's always been a significant lesson to learn, but also it had high impacts and consequences in the local economies. So as last time I was saying, for example, the COVID-19 pandemic that accelerated digital transformations. The blockade in Qatar that posed the risks of food security and not having enough supplies and maybe not having enough manufacturing within these countries. Then we look at situations such as the financial crisis of 2008 that posed the question of investments. How risky should investments be? And here, obviously, we're lucky because Kuwait is very cautious when it comes to investments.
Yes.
But yes, looking from this perspective, we can definitely say that these such situations usually reveal weaknesses in local economies, if you will, or potential threats long-term. So they accelerate massively economic diversification and expansion agendas.
Ms. Cristina, we will talk into more details about this, but I want to take this report. The Strait of Hormuz plays a critical role in Kuwait's economy and its connection to global energy markets. This narrow maritime passage located between Iran and Oman is the main route through which most of the GCC oil exports reach international markets, and prolonged instability can create uncertainty in energy markets and complicate export logistics, shipping schedules, and insurance costs for oil tankers. Here's more.
Iranian drone attacks could disrupt the Strait of Hormuz for months, but how long the Islamic Republic could sustain its missile barrage is less clear. Since the US and the Israeli occupation attacked Iran on February 28th, Iran has launched hundreds of missiles and more than 1,000 drones at Gulf states allied with Washington. Most were intercepted by the air defenses, but some residential and commercial buildings, infrastructures, and US military bases have sustained damage. In recent developments, Iran Islamic Revolutionary Guard Corps has said it maintains full control of the Strait of Hormuz, where United States President Donald Trump has said he is prepared to deploy the Navy to escort tankers. It follows days of uncertainty over one of the world's busiest shipping passages, which has seen almost all commercial traffic halt since the outbreak of hostilities in the Gulf. Closing the Strait of Hormuz, a narrow checkpoint between Iran and Oman through which a fifth of the world's crude oil and liquefied natural gas passes, has been one of Iran's main objectives, and shipping through the crucial energy artery has ground to a near halt after Iranian hits on at least 6 vessels. Iran has blocked the channel since the current round of fighting began, placing global supply chains under strain, with most ship captains unwilling to risk the crossing while fighting continues around the Gulf. International companies are now having to plan their operations without access to a route that has long been central to the movement of oil and gas. The strait carries roughly 1/5 of oil transported by sea worldwide, making it a cornerstone of global energy supplies. However, that a full blockade would not interrupt the main east-west shipping lanes between Asia and Europe. According to economic analysts and officials, the widening US-Iran war is a risk to global economic growth, but the fallout depends on how long the conflict lasts. The president of the European Bank of Reconstruction and Development, Odile Renaud, said that the conflict can reduce risk capital for the region, but that apart from Lebanon, that followed thus far was contained. Earlier this month, the EBRD pegged growth for 41 countries. It covers at least 3.6% for this year and 3.7% in 2027, boosted by spending on big infrastructure projects in Europe, but the offset by US tariff and trade uncertainty. The war has effectively closed the Strait of Hormuz, a key shipping artery, sending crude prices up some 12%, and sounding an alarm for many of the energy importing countries in which the EBRD works. Meanwhile, Goldman Sachs analysts said a temporary surge in oil prices to 100% per barrel could slow global growth by 0.4 percentage point as a widening conflict in Iran chokes off vital Middle East oil and gas flows. Under its baseline forecast, Goldman expects oil prices to increase a bit further before moderating to $76 per barrel on average in the first quarter of 2026 and $65 in the fourth quarters. In an upside scenario, it expects oil prices to rise about $100 per barrel before normalizing over the course of 2026, which under its baseline forecast. Goldman estimates a modest 0.1 pp drag on global GDP growth and a 0.2 pp boost to global headline inflation. A jump to 100% per barrel could fuel a 0.7 pp rise in global headline inflation. Higher oil prices are expected to weigh on real incomes and consumer spending, while oil exporters such as Canada and several Latin American economies may benefit. Away from oil markets, the equity indexes fell more than 1% on Wall Street and in Europe in the past days.
تؤكد وزارة الكهرباء والماء والطاقة المتجددة بأن عمليات توليد الطاقة الكهربائية وتحلية المياه تسير وفق الخطط التشغيلية المعتادة، وتؤكد الوزارة على جاهزيتها التامة للتعامل مع أي طارئ من خلال خطط متكاملة تتضمن الإجراءات الواجب اتباعها لاستمرارية الكهرباء والماء. وتوفر لدى الوزارة كفاءات وطنية مؤهلة وعلى أعلى درجات الاستعداد لتفعيل هذه الخطط متى ما دعت الحاجة. والمخزون الاستراتيجي من المياه العذبة في البلاد في ازدياد، إلى جانب توفر مخزون من المياه الجوفية، مما يعزز قدرة المنظومة الوطنية على الصمود والتعامل مع مختلف الظروف.
Welcome back. I'm here with my guest Cristina Mirica, a business development consultant and former country director of Oxford Business Group. Ms. Cristina, we saw earlier the report about the Strait of Hormuz. Now, nearly 1/5 of the world oil supply passes through the strait. What happens if the conflict disrupts this route, and what are the risks of the maritime clashes in the Arabian Gulf and the Strait of Hormuz?
I think it's an important question that you're asking now. And for us to be able to shed some light on it, we should first explain what maritime clashes are.
Mm-hmm.
And these are usually referred to as military incidents that happen at sea, mm-hmm. that have impacts in terms of disruption of commercial trade flows and shipping in general. And when we talk about those, there are usually around 3 categories we could mention. So we would have attacks on oil tankers via missiles or drones. It could be naval clashes between military vessels, direct. That fortunately didn't happen. And it could be a third option of positioning mines somewhere on the shipping lanes. And that would really create a lot of disruption. But these are just scenarios. When we talk about the disruption, here we would have to look beyond the physical damage that would be caused, because it would have economic implications. And here we're talking about shipping delays. We would be talking about increased costs, but also at very high volatility on energy markets. And so far, I think the situation has been relatively stable, not minimizing what's been happening, but so far we mainly had direct attacks on some oil tankers close to the shore of Oman and inside the strait, and mainly threats. But the situation has been more or less contained.
Now, with the energy market, we've already have seen a surge of to over $110 or $120 a barrel. Could this lead to global stagflation?
Yes, and here, to make it easier for everybody who's watching us, I would first explain what stagflation means, because that's an important point. So from an economic perspective, stagflation is a moment when two things happen at the same time. You have an increase in prices, which leads to higher inflation, and you have slower economic growth. And this is a non-normal situation, mainly because it's usually high demand that is going to raise prices. So this wouldn't be the case. Now, the main trigger of stagflation historically have been energy shocks. And the reason for that is that energy is at the base of all other industries, if you will. If we talk about manufacturing, about shipping and transportation, you name it. Absolutely all the industries rely on energy to be operational. And that, of course, translates into higher costs. So what we see in these situations is that households and businesses end up spending more on energy, which means that they're spending less on other sectors, on other markets. So this leads to lower economic growth. So that's why, yes, if the situation would be prolonged, the risk of stagflation would be higher.
So if it's prolonged, how might the OPEC Plus production strategize this move?
It's a great question. So what we know about OPEC Plus, normally their mandate is to adjust production in order to stabilize the oil prices. And so far, before the crisis started, they had already agreed as part of their yearly strategy to increase production by around 206,000 barrels per day. Now, obviously, in times of geopolitical unrest, these things change. We might see less focus on production itself, but more on ensuring stable flows of energy. Because in such situations, we know that if export terminals are affected, even if the region is going through any incident risk, let's say, we would see naturally a lower production due to that. But we would also see lower production due to a lack of storage facilities. If oil cannot get out of these markets, the storages would be full, so the production would naturally decline. Now, we don't have any definitive change in strategy from OPEC Plus. They haven't announced anything, and that's normal because usually they're very cautious in the way that they approach these things, and they would take some time to measure if this is a short-term or long-term situation, how that's going to affect. But we also know that supply is not exclusively dependent on decisions that come from OPEC, and it can be sometimes just a natural consequence of the market condition.
True. Now, still reference with the issue with the Strait of Hormuz, and also my previous guest, we discussed briefly about the airline industry and how they reroute the cargo coming in and out of the country. Now, how might Asia and Europe energy importer respond economically if shipping risks arise, and how might regional tension affect the investment confidence in the Gulf?
That's a great question. So when we talk about countries in Asia and Europe, definitely the most affected would be the ones that depend highly on imports of energy. And here we would go back to some of the strategies I was mentioning earlier. First of all, it would have to do with finding new supplies away from the countries that are being affected by the current crisis. And I was mentioning earlier other options, United States, Norway, etc. It would be at the same time the idea of accessing the supplies that they have, the strategic supplies. And this has already happened. There was, very recently, there was an announcement made by the International Energy Agency. All the members are releasing around 400 million barrels to stabilize the markets. And this is massive news. If you think about it, it's twice the size that they released back in 2022, when the political unrest and military conflict between Russia and Ukraine started. So it gives you an idea of the scale. And a third one would be increasing supply, right? Increasing supply, even if it's coming at a premium.
Interesting. Now, the French President Emmanuel Macron has announced preparation for a European-led defense mission to escort oil and gas tankers to help secure the Strait of Hormuz after the most intense phase of the conflict. Now, considering the strait's critical role in the global energy supply and the volatility we are already seeing in energy market, could prolonged disruption trigger a broader global economic shock or even a worldwide economic crisis?
The answer is yes, unfortunately. And when we think about the Strait of Hormuz, we look at it not only as a regional passage for goods and trade, we look at it as an economic checkpoint, if you will, a global economic checkpoint. And as I was mentioning, whenever you have a raise in oil prices, that's going to translate also in adjacent industries. And here we talk petrochemicals, fertilizers, diesel, shipping costs, as I was mentioning. And these translate later on into into an increase in prices to the end consumer, be that B2B or B2C. So yes, it can lead to a potential economic crisis. There's also these two factors that end up being affected, is the high inflation due to the rising costs, but also less expenditure being pumped into the economy in other sectors, which leads to lower economic growth over the longer term.
Ms. Cristina-Gabriela Mirica, it's a pleasure to have you here with us today. But before we let you go, any final words you would like to share with our viewers tonight?
Yes, I think we should definitely understand that all of these worries that we're highlighting here are not definitive. So for now, it's been only a short time. Only time will tell how this situation is going to unfold. Because if it remains a short-term risk, then we're mainly going to experience volatility. If this is going to translate into a longer-term instability, let's call it, then yes, we're going to see major disruptions in terms of economy. It doesn't have to be the case, But yeah, we have seen so far governments trying to take the right measures, because at this point is more about preventing that geopolitical shock turns into a financial crisis that's going to affect economies globally.
Business Development Consultant and former Country Director of Oxford Business Group, Cristina-Gabriela Mirica, it's a pleasure having you here with us.
Thank you so much for having me.
Let's take a quick break and we'll continue with this live coverage.